Did somebody say weekly stock market update? Oh, yes, they did. And here we go. Right, look what's going on here. All very expensive, as we know, and we've had a bit of a decline in the markets over the last couple of days, unsurprisingly. Banks still looking cheap. This is price earnings ratio. So each one of those is the multiple of the stock price compared to profitability. It's how you get rich when you do an IPO. You do a multiple of your profits. Imagine you could sell your company for a multiple of 315 times its profits. So if it was going to make, I don't know, $100 in a year in profits, you could sell it for 315 years worth of those profits, assuming those profits remained stagnant. Amazing, isn't it? That's why it's expensive at 315. Common sense. This is performance. Got a bit hit, except for the healthcare and drug manufacturers over the past week, and the banks, of course, coming back up. Now, they're undervalued as well, so you might want to have a closer look at JP Morgan and Bank of America and Wells Fargo as well. Price earnings growth ratio, another measure of valuation. That's where you're allowing for the fact that profits might grow. So today's share price is not a reflection of today's profitability, but what about future growth? Even then, virtually everything looks expensive. So let's have a look at those things. Now on the NASDAQ, we're down to just being up 41% for the year. Not bad, is it? Of course, if you're in Britain, you've only done a quarter of that. You're only up 10%, if you're lucky. Check with your pensions. I guarantee you, your pension or your IFA has not managed to even deliver you 10%, which is why I do this education, so people can learn to do it for themselves and hold their rich, fat fund managers to account. S&P 500, where are we? Well, we've had a bit of a dip, obviously. However, I'm not too worried because we've got this. Now, what should you do when you get a dip, but you think long term it's still sound? Well, you've got two options. One is you wait through the dip, and obviously you watch my weekly updates to keep on top of things, or you try and trade your investments, which is time consuming, but of course for the time you spend, and time is money, you should get a little bit of a better return. So that's where we are on the weekly stochastic. It might well fall off a bit. You are going to get some profit taking there, obviously. Now it's come in. I didn't know exactly when it would come in, but I knew when it does come in, it would be obvious that it should. And there we are. That's where it is, where my little hand is pointing over there. So let's have a look at some of the individual stocks. The FTSE 100, like I said, for a while now. However, having said all of that, the point where the MACD, which is a measure of momentum, it's this solid blue line here, where it meets its own moving average, it can often have a bit of a bump upwards before going lower. So don't be surprised if you see, and the stochastic leads the way, it tends to be a bit more sensitive, a bit more preemptive, a bit more premature, will go up before it falls down. And the MACD tends to be a bit more slower, however, more important. So yes, short term you get a bit of a rise, but actually medium to long term, don't be fooled into that. It's a trap. Okay, Apple. Now, it's holding steady. There's headwinds, as you can see from the rest of the market. We're getting a bit of a sell-off and a bit of a fall. This is anticipated, right? So you're going to get a bit of short-term pain. Now, it's up to you. Do you trade those investments? Do you get in and out of Apple? Or do you say, no, I'm a medium to long-term investor. Alpesh has told me that there's going to be some selling, but I'll keep on with it. And you can see the banks are all still very happy with it. You can see what the analysts think. That's the Apple price. And that's what the average analyst forecast is. That's what would happen if the average analyst was ever correct, and they never are. And that's the highest analyst viewpoint. Alphabet, again, taking a bit of a sideways move, bit of a breather, not surprising given how much it had moved up. So fine, let the market have a bit of a calm phase before it goes back up. And that will do that, and this will do that. So I've got my long-term holdings. I'm doing two things with it. By long-term, I mean 12 months. We'll review at the end of the year fully. I'm keeping hold of those. I don't trade my investments. But with trades, yeah, we're taking some trades off and going short on others. Right? So Alphabet, those are the analyst figures. You can have a look at it in your own time. Microsoft couldn't follow through and is again taking a breather. We've got this nice little upward move. It can't keep going at that pace. It's just too great a pace for any company. That's long term. That is, by long term I mean, well, you can see till January of this of the next year. Okay, this is what won't probably happen. It'll probably do a bit of this and then go back up. This may well happen before it does that, right? In other words, investing, I'm not worried at the moment at all. Similarly with Amazon. Now, this tends to be more volatile. Because it tends to be more volatile than Microsoft, it could easily do that before it does that. So you'll ask the question, Alpesh, what should we do? What should we do? Well, you know what to do. If you're holding for the end of the year, you see through the pain. If you've got the time, energy, and inclination, you can trade some of that. You might close some of your position, close your profits, with the risk that, of course, it just turns around and keeps rallying. Okay, so you've got your choices based on the amount of time you have available. Now you've got a strategy. Disney continues to disappoint, but I want to keep an eye on it. A, because it shows my human fallibility, but also B, because actually I think it's a good company. I think we'll be all right. Obviously, it's not a Microsoft. It's not AI. Sooner or later, they'll probably sack their CEO, get somebody in who will talk about AI, and that'll help them. So that's your Disney over there. Never understood why they don't do more Indian classics for the tapping into the Indian market rather than just Chinese classics, which they do, and nothing wrong with that, like Mulan and so on, because they really would kill the Indian market. They really could do well with it, if as long as they don't mess it up. So we've got this. That's your Nvidia potential, but it had a massive move up again this week. So if you're risk loving, you stay in it, which is me, and you keep a close eye on it. If you're risk averse, you've already taken your profits, you've run home to mummy. So there's all the buys on that one. All right? Simple, simple, simple. And through these videos, I try and educate you on how to use the MACD. See there where it says weekly, see where it says monthly. MACD, by the way, stands for Moving Average Convergence Divergence. Okay, that tells you that it is the difference between the 26-period moving average of the price. If you don't know what a moving average is, Google it. And the 12-period. And 9 tells you that this yellow line is a 9-period moving average of the dotted line, right? What does all of that mean? Well, it means it is a measure of momentum. You just have to correlate these moves with those, and you can see there's some pattern recognition that you can do. That you can notice when it's low, i.e. around the 0 mark or lower, and starting to rise, you're going to get some likely momentum. All right, this is a stochastic, and it tends to be more sensitive than the MACD. Anyway, with Tesla, we're looking at it doing that. So whilst it's getting some pullback, and I wouldn't be surprised if it pulls back further because it's volatile, if you're risk loving, you stay in it. If you're risk averse, you've already got out and taken your profits. Simple as that. You make it dependent on your risk appetite, not somebody else's, and Meta just continues, doesn't it? Similarly, like with the others, don't be surprised if you get something of a sell-off, as you can tell from the stochastic, which tends to be premature. This is probably going to get to the all-time high at some point in this year. So your upside's limited compared to your downside's not going to be all the way down there. But you take the point. It's getting riskier and riskier for you. ServiceNow took a bit of a battering this week, but it's still a stock overall that I like. But it's gonna test your patience, because you're gonna see this. You're gonna see, look at what happened in the past when that fall happens. Okay, you can get falls. You can get, falls like this. You can get falls like this. So you can get falls, even if the banks all love it. But I still continue liking it. And I'm going to have to weather a bit of a punch to the face, which is going to come from probably today and a bit of next week as we get some selling happening into the stock. Okay, now, this is the short public version. For those who are on my Great Investments program, remember you watch the one on my private Telegram channel, which is in far more detail, covers a hell of a lot more stocks, including my portfolio update as well within there. So, because somebody missed that point last time. Okay, thank you all very much for watching this. Remember, alpeshpatel.com/links for a lot of free tools and also opportunities to meet me. I just hosted an event in Parliament yesterday. There'll be more of those. Thank you very much.